All right, let's dive in. Today, we're cracking open the latest annual report from Shivalic Power Control. Now, this is a company that's basically building the electrical nerve center for India's entire industrial backbone. But the real question is, what do the numbers actually tell us about its financial health and, its future? Let's dig in and see what we find.
So first things first, what are we even looking at here? Well, these are LT and HT electrical panels. Think of them as the heart of, well, everything. They control the power for massive data centers, for hospitals, you name it. This is Shivalic's bread and butter, and honestly, without this stuff, a huge chunk of India's modern infrastructure just stops.
Okay, so we can all agree the product is super important, right? But here's the multi-core question. Does the company's financial strength actually live up to its industrial importance? To figure that out, we got to leave the factory floor behind and get our hands dirty with the numbers. Let's get right into that balance sheet.
All right, let's start with a proper financial health check. We're going to put the numbers for the 2025 financial year right under the microscope. This is where the real story begins.
First up, let's talk top line, revenue. They hit a pretty impressive 132 crore rupees in fiscal year 25. Now, to put that in perspective, that's a big jump up from 102 crore the year before. And they're saying this is all thanks to grabbing new customers, especially down in southern and western India. So yeah, that's some really solid growth right off the bat.
And what about the bottom line? Well, that revenue turned into a net profit of 12.42 crore rupees, which, is a nice, healthy profit. But, and this is a big but, the company itself mentioned that their profitability got squeezed a bit by raw material costs going all over the place. That's a little detail we need to keep in our back pocket for sure.
Okay, now we get to what is, for me, the most interesting part of this whole story, the core of the balance sheet. We're talking about the big showdown, cash versus debt.
And this is where things get kind of wild. The company is sitting on a cash pile of almost 22.3 crore rupees. I mean, for a company of this size, that's not just a rainy day fund. That's a full-on financial fortress. It gives them this incredible freedom to handle any crisis or jump on any new opportunity without ever having to go to the bank.
And here's the other side of that same coin, which is just as impressive. Their debt-to-equity ratio is a tiny 0.05. Just to be clear, anything under 1.0 is usually seen as pretty healthy. So 0.05, that's just incredible. It basically means they are virtually debt-free, especially when you look at that giant pile of cash they have. This is the definition of a fortress balance sheet.
Okay, so this table really tells the whole story. The good and the not so good. On the one hand, their liquidity is off the charts. The current ratio shot up to 9.44. That means they have over 9 times the assets to cover their short-term bills. No problem there. And that debt-to-equity ratio? We already know it's amazing. But, and you knew there was a but, here come the red flags. Look at return on equity. It got chopped in half. It went from nearly 34% down to just 16%. Now, they explain this away by saying they issued new shares, but still, that's a huge drop in how efficiently they're making profits. And then there's inventory turnover. It is slowed way down. That could mean one of two things. Either stuff isn't selling as fast as it used to, or they're stockpiling for some big future orders. Either way, it's something an investor would definitely need to keep a close eye on.
So what we're seeing is this kind of split personality, right? A rock-solid, fortress-like balance sheet, but at the same time, some kind of concerning trends in their day-to-day operations. So the big question is, how are they planning to use all that financial firepower to grow? Let's check out what they've got planned.
Well, if you ask the management, they're feeling pretty good about things. To quote them directly from the annual report, they remain optimistic for FY 2025-26. So, okay, let's see what's making them so confident.
Okay, so here's their game plan, and it's got 4 main parts. First, they're just plain building more stuff, expanding their capacity to keep up with demand. Second, and this is the clever bit, they're not just making more of the same, they're focusing on high-margin automation solutions. Think smarter, more profitable products. Third, they're teaming up with other big players to lock in future business. And finally, they're starting to look outside of India, with their eyes on the Middle East and neighboring countries. This isn't just a plan to get bigger, it's a plan to get more profitable.
All right, but a company doesn't exist in a bubble, right? So let's talk about the competitive battlefield. What are their advantages, their moats, and what are the big opportunities and risks out there?
So what's working in their favor? Well, a huge advantage is that they do their own engineering and testing in-house. That gives them total control over quality, which is a big deal. Plus, they're basically riding several massive waves at once. You've got the government's huge push for new infrastructure, the explosion in renewable energy, and the whole EV revolution. All of those things need exactly what Shivalic makes. And, like we said, the export market is a giant, basically untouched opportunity for them.
But it's not all smooth sailing. There are some serious headwinds to consider. For one, they rely really heavily on just a few big customers. That's a classic risk. What happens if one of them leaves? We've also already talked about the fluctuating costs of things like steel and copper. On top of that, they're always in a price war with smaller, unorganized players. And there's the constant threat of big projects getting delayed. Any one of these things could really throw a wrench in the works. Okay, time to put all the pieces together. We've looked at the good, the bad, and the kinda ugly. So let's lay it all out. The bull case versus the bear case for Shivalic Power Control. So, the bull case. The argument for the company is pretty straightforward. You've got that fortress balance sheet we keep talking about. They're swimming in cash, have practically zero debt, and their revenue is growing strong. Plus, they have a clear roadmap for how to grow in some really exciting sectors. The bear case, on the other hand, points to all those red flags we saw. Their profitability is dropping, that inventory is starting to pile up, they're too reliant on a few big customers, and they're at the mercy of raw material prices. It's really a classic showdown, an amazing balance sheet versus some pretty tough business challenges.
And that leaves us with the final big question. They have this incredible, rock-solid balance sheet, but they're also facing some serious headwinds. So is Shivalic truly ready to power up and accelerate its growth? All the ingredients for success seem to be there, but so are the warning signs. And the answer to that question is probably going to define the next few years for this company.
Hey, if you found this deep dive helpful and you want to see more analyses where we break down company reports just like this one, do me a favor and hit that like button and subscribe. It really helps. Thanks for tuning in.